Welcome to a Business and Wealth Strategy. My name's Karen Newton, and today I want to look at some of the headlines that I recently came across, put out as true. But once I started investigating them, I found that those headlines were very misleading and that the subtler truth is far more telling. So, what was the recent headline that I saw? Well, it claimed that HSBC Hong Kong had 35 billion of bad loans. But that figure isn't supported by data. You see, the Hong Kong property market slump is squeezing bank balance sheets. It's exposing credit fragilities and testing regulators' ability to contain the contagion. But the difference between the headlines and the facts paints a different picture. While the headlines claim there's 35 billion bad loans, the data doesn't form part of any official filings. So when I dug into this, what is verifiable is Hang Seng Bank, which is 63% owned by HSBC, has 3.2 billion in impaired property loans. A huge difference, between 35 billion. However, the alarming aspect of this is that loan debt is up 85% to last year-on-year totals. So that is an alarming trend that's happening within the market. Now, the entire Hong Kong banking system holds around 25 billion in non-performing loans. That is a 2-decade high. However, when we look at HSBC in particular, it's the Hong Kong commercial real estate exposure that is the issue for HSBC. And 73% of that book is now flagged as elevated credit risk or impaired. So what do we take from this? Well, if you read the headlines, everybody started talking about the subprime crisis. But that was something totally different. You can't really compare the two. You see, the subprime was in the early 2000s. US mortgage lenders issued huge volumes of subprime loans, mortgages to borrowers with weak credit and little verification. These loans were then packaged into mortgage-backed securities and sold globally. When interest rates rose and home prices fell, defaults spiked, and the mortgage-backed security market collapsed, triggering a chain reaction. Investors couldn't price risk, interbank lending froze, and then we had major institutions like Lehman Brothers failed, and that led to a global credit contraction. The contagion wasn't about bad loans. It was about the opacity and leverage in the financial system. So why is what we're seeing in Hong Kong different? Well, Hong Kong's problem is concentrated in commercial property valuations, not residential subprime. The loans are to corporate developers and property investors, not mass retail borrowers. And unlike 2008, these loans can't be repackaged into derivatives. They largely sit on the balance sheet of the banks that originated the loans. That makes visibility and measurable risk. So what else do we have that is affecting this, if you like? Well, the thing is that in 2008, banks had a tier 1 ratio. Now that's a terminology around banking, but they had this tier 1 ratio that was 8%. So they didn't have any margins there when things went wrong. Today, Hong Kong banks have this tier 1 ratio that is above 17%, and total capital ratios around 24%. Regulators also conduct regular stress tests and assume large drops in property values to see how well the bank will perform. Now, that doesn't mean there aren't going to be banks that go under, because there are. And we've already seen a few in the US that have gone under in recent weeks. But the thing is, there's a lot more capacity within the banking system to be able to handle some of the stresses through bad debt loans. But that doesn't mean it's not going to happen. You see, even with those strong safeguards in place, there's the risk of what we call feedback loops. So a prolonged downturn in property values, that means there's falling collateral. That means higher provisions have to be made to deal with those values dropping. That means that lending is going to get tighter, and then we're going to have slow growth. So we can see the property market is likely to contract, but we are still a long way from that collapse. Now, how does this actually affect you and me? Well, the truth is, we're in a global economy, and a global economy means that what happens on the other side of the world is going to affect us, whether we like it or not. You know, I used to live in New Zealand. If a New Zealand bank were to go down, there would be other banks that are invested in it that would affect it. No, please don't. I'm not saying a New Zealand bank is going to go down. I don't think New Zealand's actually got any banks left. They've all been sold out. But that is just an example. We are today in a global market, and whether we like it or not, what happens in one country is going to happen in another country. So what can you do for yourself? Well, the first thing is, if you have mortgages, check your loan to value clauses on those mortgages, particularly on your buy-to-lets. They are the extremely risky ones. And check those out. Get your ratios down quite a way to try and give yourself a margin between property prices dropping and you don't want that loan to value clause being broken, because the banks will want to get that property off their books as soon as possible. The other thing you can do is watch the markets and be ready to take advantage with cash options when the market stabilizes. Okay, so there's a lot more things you can look at, but there's always opportunities when we see downsides. So when we look at these headlines, and that's what I do, I look at the bad news headlines, I go in and I check what the reality of those stories are. Now, you'll find my audio, my podcast, or you'll actually find my blog, which is under commentary, karennewton.co.uk. You'll find where I share what I've interpreted as bad news and how I've interpreted it into opportunities and looked further down the horizon as to what is likely to come. So just to go back to the main part of this, hey, that bad news story, 35 billion loans, bad debt loans, it is a bad headline. Okay, it doesn't mean that it's out there. It may eventuate. I don't know. I just have to read the data. But for now, there's no need to panic within the banking sector. Okay, there is sufficient leeway within that for the banks to absorb what's happening in the markets at the moment. Thank you. My name is Karen Newton. I am a business and wealth strategist.